Okay, so today's notes are going to review over the causes of the Great Depression. So just a little background on the 20s leading up to the Depression. In the 1920s, most people assumed that we were living this life of prosperity. Life was good, everybody's over World War One, people have come home, everybody's ready to celebrate. We're kind of coming off of the skirts of the war, and so unemployment was very low. People were generally feeling as though they had a higher wage. Consumerism was really booming at this time. People were starting to take loans out on credit and buy things on time, paying installment loans as they went. So people were able to buy more materials that they normally wouldn't be able to afford before, such as refrigerators, automobiles, whatnot. And these appliances and different things that they were buying was making life easier and giving people more free time. Also, again, they were able to afford more things because they were taking out loans of credit and paying for it in chunks rather than paying in one lump sum. Because of World War One, the efficiency of factories improved a lot during this time. The assembly line was kind of mastered, and so it cost a lot less to make products, which allowed for the product's price to drop and become more affordable to the public. When people had this extra income, they started being a little bit more risky with their money. They had more disposable income, meaning that they had more to spend on their wants than just on their needs. And so people started investing this into the stock market, trying to make a profit off of their money and win big. So people practiced something called speculation and margin buying. Speculation is basically just kind of observing the stock market and making predictions and risky business investments based on businesses that they think are going to grow. And then they would buy stocks on a margin. So that essentially just means that they took out loans and bought stocks. So for example, they would buy $20,000 worth of stock, but maybe they didn't have $20,000 to put down. So they put down $2,000, which they had. They took a loan out for the extra $18,000. And then they would once their stock went over $20,000, they were now making a profit. So if the stock doubled and their stock was now worth $40,000, they could cash out. They could pay back their loan to the bank of the $18,000, and then everything else would be profit to them. So people were doing this a lot, and because the stock market was on the rise, people were really being more bold in their risky investments. This kind of backfired on us because it was overinflating the stock market and the stock prices. In 1928, President Herbert Hoover was elected. He was a Republican. He did believe in a very laissez-faire approach to businesses. He believed in this idea of rugged individualism, where the individual is responsible for themselves and they take pride in working hard for themselves and bettering themselves through hard work rather than government handouts, essentially. This idea of trickle-down economics was the idea that in order to help the average worker, you cut taxes from the top to the big businesses, and then that money would trickle down into the pockets of the middle and lower class workers. So for example, if you cut taxes on the big businesses would then take that money that they got from the tax cuts and they would increase the pay of their workers. And so it would trickle from the bottom or the top down. Essentially, that didn't really always happen. A lot of times big business owners either took that money, reinvested it in their business to make themselves a bigger profit, or they would take it and play in the stock market, or they would pocket the money for themselves and not do anything with it. So it never trickled down to the workers a lot of times. So some of the problems that were brewing in the 1920s led to the beginning of the Great Depression in 1929. So what we're going to do is we're going to look at 7 different causes that led to the Great Depression. Now you have to remember that there isn't one single event that made this happen in a Great Depression. Just like in World War I, when there were a lot of underlying causes that made things a world war, but we officially say the start of the Cold or the World War I was the assassination of Franz Ferdinand. Um, it's the same kind of thing as the Great Depression. There's got to be several factors that make it as big as it really is. So some of these things were building up before the 1920s or during the 1920s and maybe even earlier. Others were happening after the event that we say marked the beginning of the Great Depression, which was the stock market crash. So they're all kind of in combination with each other, which made it this Great Depression. If you take some of these factors out, then the Depression may not have been what it actually was, this 9, 10, 11-year period of economic decline. So the first cause we're going to look at happened before the stock market crash, and it was well into effect after World War I and through the 20s, which was overproduction in farming and industry. So during World War I, businesses and farms were producing large amount of products and crops to help supply the war. Business owners and farmers were taking out loans so that they could expand. They were all in wartime production, so farmers were growing enough crops for food for the American public and as well as soldiers overseas, and businesses were also producing for the American public and as well as overseas. And so overproduction was bound to happen, especially when people were starting to demobilize after World War I. When the war ended, there was a surplus of goods, especially food. Businesses and farmers lost money. They couldn't pay off the loans that they took to expand during World War I because they were losing money financially from the surplus of goods. And so this was kind of causing businesses and farmers particularly to default on their loans. And the loans come from the banks. So if the banks aren't getting the loans paid back, then they don't have that income coming back in that they lent out to recirculate. The second cause was also building in the 20s, which was buying good on credit or buying on time. So Americans seemed like they were living very prosperously in the 20s, but that's because they were getting themselves really into debt. They were living beyond their means. Advertising and businesses had made it very easy to take out lines of credit. There weren't credit checks like are now. There was not like high interest rates as are now. It was much easier to get a loan then. And people were overextending themselves, and eventually they weren't able to pay off their debt, and that put them in financial hardship. The third cause was just looking at America as a whole and realizing that we had a very uneven distribution of income. There was a very large gap between the rich and the poor in the 20s. We just were seeing the emergence of a middle class. More than 70% of families were living below the poverty line, making less than $2,500 per year. Over half of the homes had electricity or heat, so only essentially half of the homes were living in this modern day society and could afford this. Especially if you get into more rural areas. And we were just really entering this economic decline that was building in the 20s with the extension of credit as well, kind of hurting the income of the lower middle classes. So the banks closing is kind of a result of the stock market crash and a result of the overextension of credit. So once the stock market crashed, people rushed to the banks because they wanted to take out whatever savings they had left. The problem is that many banks had loaned out way too much money to stock investors. Many banks actually invested in the stock market themselves with the depositors' money, and they lost that with the crash. And again, people were loaning money out for loans on credit and whatnot. So as people began defaulting on their loans, they couldn't pay the money back to the banks. So the banks loaned out the money. They didn't have any coming back in. People rushed to the banks to take out whatever they had left, and there was nothing left for them to take out. And so banks ended up closing. There was no insurance on your money at this time, so people lost their entire life savings. Some people lost, maybe 10, 20 bucks, $1,000, saving for a long time, even hundreds of thousands of dollars or millions of dollars depending on where they were. So it was a lot of stress on the people. Lots of people ended up committing suicide as a result of this. So mistakes by the Federal Reserves, this is kind of tying in through the 20s and up through the 30s as well. The Federal Reserve is essentially the part of the government that controls the money supply. And they had not set high enough regulations for our banks. So banks were loaning out too much money. They didn't keep enough money on reserve. They have to keep a certain percentage. The Fed did not increase interest rates when they saw that there was too much money coming in or out. So the Fed's job is basically to study the economy and then decide on what needs to happen to keep it like stable in the middle. So we have this period of prosperity and recession all the time. It's called the business cycle. The government and the Fed is trying to keep the economy as stable as possible so that our unemployment rates are low and we're healthy and we don't have large periods of inflation. And so the government does this by raising interest rates or lowering interest rates to encourage or decrease spending, and same thing with the amount of money that's on reserve. If they want to increase spending and try to bring up the economy, then they lower interest rates and they lower the reserve rates. If they want to tighten up spending because we're getting a little too much hyperinflation going on, then they would tighten up the money supply by increasing the amount of money on reserve and increasing interest rates. The government should have stepped in and increased interest rates and the amount of reserve, but they didn't do that until it was too late, and our economy was already overextended and beginning to spiral downward. The sixth cause is actually a result of Hoover trying to fix some of the problems of the Great Depression with the stock market crash, and that was the Hawley-Smoot tariff. So if you remember, a tariff is a tax on imports. Congress raised the tariff to the highest rate ever in American history, and the point of this was to protect American farmers and American businesses from foreign competition, get people to buy American-made products over foreign goods. But what we didn't take into account was how our economy had changed since we became industrialized and how much interdependent we were as a nation on world trade. And so when they actually increased this tariff, it hurt our businesses because the Europeans retaliated by increasing tariffs in their country. We weren't able to sell goods to other nations at the same rate as we were before because of the high cost to do so and to purchase from us. And so world trade fell more than 40%. Businesses suffered. They had to lay off employees. It increased unemployment. So it did the exact opposite than what it was supposed to. And when Roosevelt came into power, he reversed this tariff. The last cause is the one that everybody knows, and this is kind of the event that sparked the Great Depression, as we say, and this was the stock market crash. There was only a small percentage of people that actually invested in the stock market, but the stock market crash made people nervous and made people tighten up their spending, and that's when all these other factors came into play then, because if we're not spending money and we're saving money, we're slowing down the economy and causing prices to fall and balance out. So there were a lot of people that began buying stock, and as I said, they were buying on credit, they were buying on a margin, and the stock market became overinflated, and when the prices began to settle back down, a lot of times they were settling to lower than what people had purchased them for. So people essentially were losing money, or it looked like they were losing money in the stock market. People ended up selling their stock, which caused prices to fall further, and then that caused a panic where everyone started selling, and the stock market essentially crashed, stock going to like near nothing value. And that was on October 29th, 1929. We call it Black Tuesday, and this is the date that we coin as beginning the Great Depression.